Something unusual is happening beneath the surface of the global financial system. It isn't showing up in daily headlines. It isn't discussed openly by policymakers. And yet, it is one of the most important monetary shifts of the past half-century. Central banks are buying gold aggressively, not small symbolic amounts, not incremental rebalancing. Billions of dollars worth of physical gold acquired quietly, consistently, and across continents. From emerging economies to developed nations, institutions that once reduced gold holdings are now reversing course at record speed. This is not accidental. And it is not a coincidence. For decades, gold was treated as a relic. After the collapse of the gold standard, central banks pivoted toward fiat currencies, especially the US dollar. Treasury bonds became the backbone of reserves. Gold was viewed as inert, non-yielding, and unnecessary in a world governed by financial engineering and monetary policy. That era is ending. Over the past several years, central banks have become net buyers of gold at levels unseen since the mid-20th century. What makes this shift extraordinary is not just the volume. It is the timing. These purchases are accelerating during a period of high debt, geopolitical fragmentation, sanctions, inflationary pressure, and declining trust in the existing monetary order. Central banks do not act emotionally. They act strategically. When they move in unison, it signals a reassessment of systemic risk. Gold is not being purchased because it is fashionable. It is being purchased because it solves a problem that paper assets cannot. To understand why this matters, you must first understand what gold represents to a central bank. Gold is not an investment. It is insurance. Unlike currencies, gold carries no counterparty risk. It cannot be defaulted on. It cannot be printed. It does not rely on political stability or financial credibility. It exists outside the system, and that is precisely why it matters when the system itself is under strain. For years, central banks reduced gold holdings because confidence in global institutions was high. Globalization expanded. Trade flowed. Financial markets deepened. The dollar's dominance seemed unassailable. But confidence is not static. It erodes gradually, then suddenly the first cracks appeared after the global financial crisis. Quantitative easing, once considered an emergency measure, became permanent policy. Balance sheets expanded. Interest rates were suppressed. Debt levels ballooned. Gold responded quietly at first. Then came inflation. Then came sanctions weaponizing currency systems. Then came geopolitical fragmentation. Each event added weight to the same conclusion. Reserves tied entirely to paper promises carry systemic risk. This is where gold re-enters the picture. When a central bank buys gold, it is making a statement, not to markets but to itself. It is acknowledging uncertainty about the future structure of the monetary system. It is preparing for scenarios where trust between nations weakens, where settlement systems fracture, and where financial leverage becomes a liability rather than a tool. Notably, many of the largest buyers are countries seeking to reduce reliance on a single reserve currency. This does not mean abandoning the dollar overnight. It means diversifying quietly, without announcement, without panic. Gold allows that diversification without confrontation. Unlike selling bonds publicly, buying gold does not destabilize markets. It is gradual, discreet, strategic. And that discretion is the point. What makes this moment different from past cycles is coordination. These purchases are not isolated decisions. They are part of a broader reassessment of how value, trust, and power interact in a multipolar world. The message is subtle but clear. The old assumptions no longer hold. If fiat systems were unquestionably stable, gold would be unnecessary. The fact that central banks are accumulating, it tells you they are planning for outcomes that public messaging does not acknowledge. This is not about collapse tomorrow. It is about resilience over decades. And when institutions with the longest time horizons on Earth reposition, it is worth paying attention, because central banks move first and the public moves last. To understand why central banks are buying gold, you must understand what they are quietly reducing: dependency. For much of the modern era, The global financial system has revolved around a single axis: trade settlement, reserves, debt issuance, liquidity, all anchored to one dominant currency. This structure delivered efficiency and stability until at the IDN single quotes T. Central banks are not rejecting the dollar outright. They are acknowledging a risk concentration that no longer aligns with today's world. The problem is not the currency itself. The problem is over-reliance. When reserves are concentrated in another nation's debt instruments, financial security becomes political. Access to liquidity becomes conditional. Settlement systems become leverage. Recent years have demonstrated this reality in real time. Sanctions have shown that reserves can be frozen. Payment rails can be restricted. Access can be denied. These tools were once considered extreme. They are now normalized. For central banks, this changes the calculus. Gold is politically neutral. It does not depend on permission. It does not require access to foreign systems. It does not sit on another nation's balance sheet. This is why gold becomes attractive in periods of fragmentation. Another factor driving gold accumulation is debt sustainability. Major economies are carrying debt loads that would have been considered unthinkable a generation ago. Servicing that debt increasingly relies on low interest rates, financial repression, or monetary expansion. From a central bank's perspective, this creates asymmetry. Paper reserves are claims on systems that require perpetual confidence. Gold is a claim on nothing, and that is its strength. There is also a signaling effect. When central banks buy gold, they are quietly hedging against currency volatility and long-term inflation risk. Even if inflation moderates, the precedent of aggressive monetary expansion has altered expectations permanently. Gold does not yield, but it preserves optionality. It allows central banks to respond to future shocks without being forced into immediate alignment with any single bloc or currency system. This shift also reflects changing global power dynamics. As economic influence disperses, the incentive to rely on a single financial anchor diminishes. Gold provides a common denominator in a world moving toward pluralism rather than uniformity. Importantly, central banks are not buying gold to speculate on price. They are buying it to remove uncertainty from their reserve composition. This distinction matters. Private investors chase returns. Central banks chase stability. When stability becomes harder to guarantee through traditional assets, alternative anchors gain relevance. Gold is not replacing currencies. It is rebalancing the system, and rebalancing at this scale does not happen unless decision-makers see structural change ahead. The most important question is not why central banks are buying gold. The most important question is what this signals for the future. Gold accumulation does not predict a return to a gold standard. It predicts a world where trust is fragmented. Alliances are fluid, and financial systems must withstand political stress. In such a world, value storage becomes strategic again. For decades, individuals were taught that gold was unnecessary, that modern finance had evolved beyond it, that productivity assets alone were sufficient. Central banks are now quietly contradicting that narrative. This does not mean everyone should rush to buy gold. It means the rules of wealth preservation are changing. If institutions with access to the best information, longest horizons, and lowest tolerance for systemic risk are increasing exposure to an asset, it is worth asking why. The answer is not fear. It is realism. Gold performs best not during growth booms but during transitions, periods when monetary regimes evolve, when old assumptions are renegotiated, when confidence is unevenly distributed. We are entering such a period. For individuals, the lesson is not imitation, it is interpretation. Gold's role is not to replace productive assets. It is to anchor portfolios during uncertainty. Central banks are not abandoning the system. They are preparing for multiple outcomes within it. That mindset, preparation over prediction, is the real insight. The future of global finance will likely be more complex, not less. Multiple currencies, multiple settlement systems, multiple centers of influence. Gold fits that future precisely because it does not belong to any one of them. Central banks understand this. quietly, strategically, without commentary. By the time this shift becomes obvious to the public, positioning will already be complete. Gold does not announce regime change. It accumulates before it. And that is the truth central banks are acting on today.